This is Shukri Ahmed from FAO. I am the Deputy Strategic Program Leader for building resilience against shocks and crises. Today I will be talking about index-based insurance, the experiences we have, and some of the theoretical appeal, but also some of the experimental and actually application challenges and issues. So I think I will start by maybe talking a little bit about the risk in smallholder agriculture specifically. I think generally the largest risk which farming communities overall or agricultural households and communities face is the covariate risk. This means it is affecting all farmers in very wide locations simultaneously, and the primary source of this usually is related to weather. And these shocks are the ones which are very detrimental to smallholder farmers. Over the last 30 years, we have several data, especially in Africa, that shows more than 1,000 natural disasters have occurred. And it affected more than 300 million people with trillions, almost 24 trillion estimated dollar damage to their investment. So this is a huge investment that is affected, and this is a huge risk that the smallholder agriculture is facing. One of the most, I think, pervasive ones of these overall risks, especially in Africa, is drought, and it affects most of the people having the largest damage cost to the areas. And these covariate risks usually are uninsured largely because smallholder farmers, there are too many and it's not insured. So this usually affects negatively the investment and the farmers' innovative activities, and also it kind of inhibits new innovative works, especially now with climate change and these occurrences to go into innovative technologies. It inhibits the farmers, and it actually in the end it ends into this vicious cycle of low productivity, low income, low investment that they actually wallow in. There is conventional insurance. In some parts they actually use it, but for smallholder farmers that has a lot of problems. Moral hazard is one of them, where insured farmers simply would increase risk taking. There is adverse selection, meaning that the information, the asymmetric information out there would kind of make farmers with risks above the insurance premiums actually to buy insurance, which is not usually liked by insurance providers. So the supply side and the demand side doesn't usually come nicely, and there are weak institutional, to enforce the contracts, and there are a lot of institutional problems also related to that. So this is where index insurance comes in. It kind of creates a situation where it is a relatively new area, innovative, and kind of the provision of this insurance, it pays out benefits on the basis of an index, which usually relates to the loss of either assets or investments from some hazardous event. The payments are triggered usually out of when a certain index crosses a given threshold, which signals a disaster. So this delinks the insurance payments from the individual level losses, and it doesn't have to go into the process of actually going into the farms, which is too costly. So the appeal then is also that it is objective, it is verifiable by all because the data is out there, and it is nobody can manipulate it. So based on this climatic data, for instance, this is index-based insurance, especially weather related, There are meteorological stations, rainfall, hail, so people can actually check out this data that is out there and available. It can also be based on average outcomes, so you can have a combination of this index as well. There are a lot of experiments that are being done, and it avoids the moral hazard that we have discussed a little bit earlier. There are different levels of index insurance. It gives it for, and it can be tailored geographically and in different also levels. For example, micro level insurance that targets individuals or households. You may have a meso level index insurance where it covers a bit the risk aggregators. For instance, it could be the agribusinesses, it could be farmers unions or cooperatives. It could also be, as is done in certain parts like Ethiopia, the tests of funeral societies. So it can actually come from a bit of a higher level of aggregation. The other one is macro level index insurance, which is usually the liabilities that the governments might face in case of big disaster. There is a good example here, for instance, of the Africa risk capacity and others, which are sovereign and macro level. But index insurance, despite its appeal, it also has some challenges. Overall, it is work in progress. Now, there are several developing countries that have introduced on a pilot basis in different parts and in different combinations, and people are trying to learn from them what is the best way of introducing them. But from these pilots, what we have now realized is that generally the take-up of this is very limited and to some extent disappointing. So some of these studies have shown that why this low uptake, there are other risks, that are not faced by farmers. The quality of the contract design may not be good enough, and even within the rainfall, for instance, if it is a rainfall index, it may not capture the different range of that rainfall. There are other constraints. Even if this is covered, they don't have the credit, the financial service constraints. Other input markets, for instance, are not there. So the farmers are, facing a lot of other institutional and hazard and other risks as well that limits actually their appetite for this uptake. Also, I think that the drawbacks, main drawback of index insurance is what is known as the basis risk. Basis risk is mainly the index insurance, which arises when the index measurements do not match the insured's actual losses, and this creates a gap. And the bigger that is, actually, the low demand for these index resources. Generally, they're grouped into two major sources. One being the poorly designed products, and the other is actually geographical, which have differences in different parts. There are, some tests to actually work on this, and it could be fixed to some extent. For instance, you can have a lot of weather stations to have more accurate locally measurement, but these are costly and they really require big initiatives and as a public good, actually. So the presence of the other pests, diseases, other also climate, non-weather related, climate also related, could also be other factors that will affect. So what are key lessons learned so far? They have unusual promise as an institutional innovation. The simplicity of it, the independence of it, the verifiability of it, but it faces the difficulty of low take-up. So to scale up these, there is a need to invest on the enabling environment, which is institutional setup. Developing countries need to have different, even from legal, from also data collection and others. So these institutional setup need to be strengthened. We have to reduce the basis risk significantly, and others like risk layering and the strategic subsidy to different parts of the society as well. So I think overall, there is a big promise that we have in this, but it needs actually a type of investment, public investment, to attract private investment into the sector for it to be sustainable and viable. And in all this then, it relates always to, especially now with climate change, we need these innovative tools to actually use them for the farmers to adapt to these climate change effects and impacts, but also to mitigate these by using a more either drought resistant and climate smart type of agricultural tools. Thank you.